All right. Hello everyone. This is Flora again. And for this week's lecture, chapter 12, we'll be going through the last part of part 4, the global monetary system, and take a look at the global capital market. And as usual, I've listed the objectives. So after finishing this chapter, we'll be able to describe the benefits of the global capital market, identify why the global capital market has grown so rapidly. We can understand the risks associated with the globalization of capital markets, and we can compare and contrast the benefits and risks associated with the euro currency market, the global bond market, the global equity market. And last we can understand how foreign exchange risks affect the cost of capital. So, before we start off, would anyone be willing to share what you've read about on the global capital market and your understanding of what it does? Simply put, the global capital market is a place where savings meet investment. Let's take away global for a moment and understand what capital markets are. Capital market is a market where buyers and sellers engage in trade of financial securities, such as bonds or stocks. It consists of the primary market, where new securities are issued and sold, and the secondary market, where already issued securities are traded between investors. The most common capital markets are the stock market and the bond market. So now we put global back and it's easier to understand. So global capital market is the interlinking of various investment exchanges around the world that enable individuals and entities to buy and sell financial securities on an international level. And over the last 30 years, our world shifted away from which national capital markets were segmented from each other by regulatory barriers to capital flows and leans towards a world in which the capital market is becoming increasingly global. So, with much said, let us take a look at this week's opening case, Chinese IPOs in the United States. In the year 2018, many Chinese firms undertook initial public offerings, which is what IPO stands for, in the United States. The IPOs were strongly weighted toward technology companies, which included Tencent's video platform, iQIYI, which is considered a Chinese rival of Netflix, and also electric car maker NIO, which is dubbed the Tesla of China. Some 33 Chinese companies had IPOs on the New York Stock Exchange and NASDAQ, which is National Association of Securities Dealers Automated Quotations. This is a global electronic marketplace for buying and selling securities, and it's the world's first electronic exchange. And most of the world's technology giants, such as Apple, Facebook, are all listed on the NASDAQ. The 33 Chinese companies IPO raised around 9.17 billion in dollars in the process. So, given the escalating trade war tensions between the US and China during 2018, the vibrant market for Chinese IPOs in the United States was somehow surprising. However, Chinese tech firms had compelling reasons for doing IPOs in America, though it did start off pretty rough. Chinese investors had smaller appetite for technology IPOs, which they deem as more risky than the IPOs for more established enterprises. But on the other hand, there was a strong appetite for investing in Chinese tech IPOs in the United States. And the reason behind this is because many investors see this as a way to participate in China's enormous domestic market and vibrant long-term growth prospects, particularly in technology, as China's living standards continue to rise. And another factor is that stock market regulations make it easier for founders to retain control of their enterprises after IPOs in the United States. American exchanges allow dual-class shares. The class offered to the general public often has limited or no voting rights, while the class available to founders and executives has more voting power and often provides for majority control of the company. And American exchanges allow IPOs for enterprises that have yet to generate revenues, such as research stage biotech companies, while Chinese exchanges have historically not allowed that. However, there are certain risks associated with investing in Chinese IPOs offered through American exchanges. In addition to dual class shareholdings, they can have complex ownership structures. Typical Chinese IPO uses variable interest entities. The Chinese company creates two entities, one in China, in mainland China, that holds the permits and licenses needed to do business there, and the other on an offshore entity in which foreign investors can buy shares through an IPO. The risk here is that foreign investors don't actually own stock in the Chinese domiciled company. Local management or the Chinese government could force a split with the listed company, which leaves the United States or other foreign investors. Not United States, which leaves the US or other foreign investors high and dry. So the opening case shows that China is raising capital in another country by offering its stock for sale there. And in 2018, 33 Chinese firms, as we saw just earlier, raised $9 billion in capital by undertaking IPO overseas. And they did this, the reasons they undertook IPOs in a foreign country is to take advantage of the stronger demand in the United States for shares in risky Chinese tech IPOs. The cost of capital was also lower in the United States compared to those in China. And regulatory differences also makes it more attractive to raise capitals in certain markets, such as New York's ability to establish dual ownership structures and variable interest entities. So just in case, if you don't know, variable interest entity is called the VIE, and it refers to a legal business structure in which an investor has a controlling interest despite not having a majority of voting rights. So all of these are what makes it an attractive location for all of these are what makes New York an attractive location for tech ventures to raise capital. So chapter 12 is all about global market for capital. We'll go through the benefits associated with the globalization of capital markets. We'll go through the benefits associated with the globalization of capital markets first and study the growth of the international capital market and macroeconomic risk associated with such growth. Next, we'll review three important segments of the global capital market: the euro currency market, the international bond market, and the international equity market. Like always, we'll finish the chapter by taking a look at some of the implications for the practice of international business. Oh wow, I totally forgot to switch my PPT. Third, implications for the practice of international business. Alright. So, first, we're gonna take a look at the benefits of the global capital market and the functions of a generic capital market. Capital markets bring together those who want to invest money and those who want to borrow money. Those looking forward to invest money include corporations with surplus cash, individuals, and non-bank financial institutions such as insurance companies or pension funds. Those, on the other hand, who want to borrow money include individuals, companies, and governments. And those who work in between the two groups are the market makers. Market makers are the financial service companies that connect investors and borrowers, either directly or indirectly. And the market makers include commercial banks and investment banks. Commercial banks refers to a financial institution that accepts deposits, offers checking account services, and basic financial products. It makes various loans and mortgages, basic investment services, as well as other services such as safe deposit boxes. They perform an indirect connection function. They take cash deposits from corporations and individuals and pay them a rate of interest in return. They take the money and lend it to borrowers at a higher rate of interest, making a profit from the difference in interest rates. Commercial banks provide basic banking services and products to the general public, both individual customers and small to mid-sized businesses. These banks make money from service charges and fees. These fees vary based on the products, ranging from account fees, such as monthly maintenance charges, minimum balance fees, overdraft fees, and non-sufficient funds charges. Also, safe deposit box fees and late fees. Many known products also contain fees in addition to interest charges. They also earn money from interest they earn by lending out money to other clients. The funds they lend comes from customer deposits. However, the interest rate paid by the bank on the money they borrow is less than the rate charged on the money they lend. For example, a bank may offer savings account customers an annual interest rate of probably let's say 0.25%, but they charge mortgage clients a possible 4.75% in interest annually. So next, investment banks refers to a financial service company that acts as an intermediary in large complex financial transactions. Their clients include corporations, pension funds, other financial institutions, governments, and hedge funds. They specialize in managing complex financial transactions such as IPOs, initial public offerings, and mergers for corporate clients. Investment banks perform a direct connection function. They bring investors and borrowers together and charge commissions for doing so. Let's say, for example, Goldman Sachs. I believe it's Sachs. Or Sachs. Goldman Sachs, one of the world's well-known investment bank, may act as a stockbroker for an individual who wants to invest some money. Its personnel will advise her as to the most attractive purchases and buy stock on her behalf, charging a fee for the service. Investment banks earn commissions and fees on underwriting new issues of securities via bond offerings or stock IPOs. So both commercial and investment banks are the market makers in the world, and they are either direct or indirect. So next we come to our second question of the day. What are the two main ways for someone to access the capital market? Let me drink some water real quick. The two main ways that someone can access the capital markets is either as debt or equity. While there are many forms of each, but put very simply, debt is the money that's borrowed and must be repaid, and the equity is the money that is invested in return for a percentage of ownership, but is not guaranteed in terms of repayment. Capital market loans to corporations too are either equity loans or debt loans. An equity loan here is made when a corporation sells stock to investors. The money the corporation receives in return for its stock can be used to purchase plants and equipment, pay wages, fund R&D projects, and etc. A share of stock gives its holder a claim to a firm's profit stream. Then the corporation honors this claim by paying in dividends. Wow, I can't speak today. Then the corporation honors this claim by paying dividends to the stockholders. The amount of dividends are not fixed. Instead, they are determined by management based on how much profit the corporation is making. Stock prices increase when a corporation is projected to have greater earnings in the future, which increases the probability that will raise future dividend payments. So, an equity loan uses the assets you have acquired for your business as collateral for financing. Because in the business world, if you are not growing, you are shrinking. It's just that easy. Now, the debt loan requires the corporation to repay a predetermined portion of the loan amount at regular intervals regardless of how much profit it is making. Debt loans include cash loans from banks and funds raised from the sale of corporate bonds to investors. When investors purchase a corporate bond, he or she purchases the right to receive a specified fixed stream of income from the corporation for a specified number of years until its deadline, which is called the bond maturity date. The maturity period of debt loans vary from the very long term, such as 20 years, to an extremely short-term loans, such as those with a maturity of just 1 day. So next, we're gonna go into the benefits of the global capital market and the attractions of the global capital market. So the global capital market benefits both borrowers and investors. It benefits borrowers by increasing the supply of funds available for borrowing and by lowering the cost of capital. It benefits investors, on the other hand, by providing a wider range of investment opportunities, allowing them to build portfolios of international investments that diversify their risks. So next we're going to take a look at both the borrower's perspective and the investor's perspective of participation in the global capital market. From the borrower's perspective, in a domestic capital market, the liquidity of the market is limited. Investors are limited to residents of the country, placing an upper limit on the supply of funds available to borrowers. But contrarily, a global capital market, with its much larger pool of investors, provides a larger supply of funds for borrowers to draw on. The most important drawback of the limited liquidity of a purely domestic capital market is that the cost of capital tends to be higher than it is in a global market. The cost of capital mentioned here is the price of borrowing money, which is the rate of return that borrowers must pay investors. This is what we commonly know as the interest rate on debt loans and the dividend yield, a financial ratio that tells you the percentage of a company's share price that it pays out in dividends each year. And it is expected that capital gains on equity loans. In pure domestic market, the limited pool of investors implies that borrowers must pay more to persuade investors to lend them money. But in the international market, the larger pool of investors implies that borrowers will be able to pay less. Problems of limited liquidity are not restricted to developing nations, though, which tend to have smaller domestic capital markets. And in recent decades, large enterprises based in the world's top economies are tapping in the international capital markets in search for greater liquidity and a lower cost of capital. Now we're going to take a look at the investor's perspective. By using the global capital market, investors have a much wider range of investment opportunities than in a purely domestic capital market. The reason behind this is because investors can diversify their portfolios internationally, thereby reducing their risk to less than what could be achieved in a purely domestic capital market. Now let's take a look at how this works in the case of stock holdings. Consider an investor who buys stocks in a biotech firm that has not produced a new product. The price of the stock is very volatile, which means it could change. It's not constant. Because investors are buying and selling the stock in large numbers in response to information about the firm's prospects. These stocks are considered risky investments. Investors win big if the firm produces a product that is in favor of the market, which means the product is gonna sell well. But investors may also lose all their money if the firm fails to come up with a product that sells. Investors could then guard against this risk associated within the stock by purchasing other firm stocks, those whose weaker or negatively correlated with the biotech stock in particular. So this way, by diversifying and holding a variety of stocks, the losses incurred when some stocks fail to live up their promise are offset by the gains enjoyed when other stocks exceed their promise. So it's kind of like balancing, I think. When an investor increases the number of stocks in his or her portfolio, the portfolio risk declines. The risk declines rapidly at first until it falls off and approaches the systematic risk of the market. And the systematic risk refers to the risk inherent to the entire market or market segment. It is also known as the undiversifiable risk, volatility, or market risk, and it affects the overall market, not just a particular stock or industry. Systematic risk is both unpredictable and impossible to completely avoid, because these movements are attributable to macroeconomic forces affecting all firms in an economy, rather than factors specific to an individual firm. By diversifying a portfolio internationally, an investor can reduce the level of risk even further because the movements of stock market prices across countries are not perfectly correlated. For example, let's take a look at the correlation among 3 stock market indexes. The 3 markets we're going to look at is the S&P 500, the Morgan Stanley Capital International Europe, Australia, and Far East Index, and the International Finance Corporation Global Emerging Markets Index. The Standard & Poor's 500, which is S&P 500, summarized the movement of large U.S. stocks. The Morgan Stanley Capital International Europe, Australia, and Far East Index, the EAFE, summarized stock market movements in other developed nations. The International Finance Corporation Global Emerging Market Index, the IFC, summarized stock market movements in less developed emerging economies. From 1981 to 1994, the correlation between the S&P 500 and EAFE indexes was 0.45, suggesting that they moved together only by 20% of the time. The correlation between the S&P 500 and IFC was even lower at 0.32, which means they moved together only a little more than 10% of the time. So now you're probably wondering why market correlation even matters, right? It can be used for individual securities like stocks, or it can be used to measure general market correlations such as how asset classes or broad markets move in relation to each other. Investors use a measure of the correlation of all the assets in a portfolio to help determine the most efficient frontier. This concept helps to optimize expected returns against a certain level of risk. Including assets that have a low correlation to each other helps to reduce the amount of overall risk for a portfolio. So to put it another way, correlations play an important role because they are used to forecast future trends and to manage the risks within a portfolio. For example, a trader might use historical correlation to predict whether a company's shares will rise or fall in response to a change in an interest rate or commodity prices. Similarly, a portfolio manager might aim to reduce their risk by ensuring that the individual assets within their portfolio are not overly correlated with one another. So, low correlation between the movement of stock markets in different countries reflects two basic factors. The first is that countries pursue different macroeconomic policies and face different economic conditions. So their stock markets respond to different forces and move in different ways. Second, some stock markets are still somewhat segmented from each other by capital controls, that is, by restrictions on cross-border capital flows. The most common restrictions include limits on the amounts of a firm's stock that a foreigner can own and limits on the ability of a country's citizen to invest their money outside that country. Like until recently, it was difficult for foreigners to own more than 30% of the equity of South Korean enterprises. The implication here is that by diversifying a portfolio to include foreign stocks, investors can reduce the level of risk below that incurred by holding only domestic stocks. That is, to not put all your eggs in one basket. I believe Dr. Chu has mentioned that before. Bruno Solnick, a professor of finance at HKU of Science and Technology, came up with a classic study. A fully diversified portfolio that contains stocks from many countries is less than half as risky as a fully diversified portfolio that contains only United States stocks from the US. Solnick found out that a fully diversified portfolio of international stocks is only about 12% as risky as a typical individual stock. However, there is perception, common among investment professionals, that the growing integration of the global economy and the emergence of the global capital market have increased the correlation between different stock markets and reducing the benefits of international diversification. Many argue today that if the United States economy enter a recession and the United States stock market declines, other markets follow closely, such as the financial crisis that started in the United States, swept around the world in 2008 to 2009. Another study carried out by Solnick and his associate looked at the correlation between 50 major stock markets in developed countries between 1971 and 1998. They found that on average, the correlation of monthly stock market returns increased from 0.66 in 1971 to 0.75 in 1998, suggesting that this average relationship was not strong and that there was considerable variation among countries. Similar studies recently confirmed this basic finding, suggesting that even today, most of the time, a portfolio equally diversified across all available markets can reduce portfolio risk to about 35% of the volatility associated with a single market. International portfolio diversification can still reduce risk. But moreover, the correlation between stock market movements in developed and emerging markets seems to be lower, and the rise of stock markets in developing nations has given international investors many more opportunities for international portfolio diversification. Floating exchange rates introduce an additional element of risk into investing in foreign assets. Adverse exchange rate movements can transform otherwise profitable investments into unprofitable investments. So next we're going to go to the growth of the capital market. So according to data from the Bank for International Settlements, the global capital market is growing at a rapid pace, very fast. Stocks, bonds, and bank loans currently total over $300 trillion, which is more than 3 times the size of the world economy. The two factors driving this growth includes what and what? Advances in information technology and deregulation by governments. Information technology plays a very important role here, guys. Financial services is an information-intensive industry. It draws on large volumes of information about markets, risks, exchange rates, interest rates, creditworthiness, and so on. It then uses this information to make decisions about what to invest, where, how much to charge borrowers, and how much interest to pay to depositors, and the value and riskiness of a range of financial assets, including corporate bonds, stocks, government securities, and currencies. The financial services industry has been revolutionized more than any industry industry by advances in information technology since the 1970s because of the information intensity. International communications technology has facilitated instantaneous communication between any 2 points on the globe. Advances in data processing capabilities have also allowed market makers to absorb and process large volumes of information from around the world. Technology has overall driven a persistent ultimatum for accessibility and innovation, and being able to have convenience is going to be something that keeps changing forever. According to a study, the development of these technologies had affected the real cost of recording, transmitting, and processing information to fall by 95% between 1964 to 1990. Such developments have facilitated the emergence of an integrated international capital market. It is now technologically possible for financial services companies to engage in 24-hour-a-day trading, whether it is in stocks, bonds, foreign exchange, or any other financial asset. Online banking and transactions and mobile payments are incredibly popular in our society today. Like, for example, you can buy something on Taobao and then you just transfer money through your phone, and it's just super convenient for anyone who has a phone by themselves. Whatever. If you know, you know. Well, there are a ton of vulnerabilities since financial transactions are being used so much. Many financial institutions have to adapt to the latest security and updated technology in order to stay up to date. There are billions of financial transactions that are happening on a day-to-day basis. Due to the advances in communications and data processing technology, the international capital market never sleeps. Never, ever, ever. San Francisco, I can't really imagine what it's like if it kind of sleeps for just an hour. What is gonna happen to the world, knowing that you can't transfer money, there's no technology for that 1 hour. It's just kind of scary for our society who depends so much on technology now. There are billions of financial transactions that are happening on a day-to-day basis. While I just reread this. Due to the advances in communications and data processing technology, the international capital market never sleeps. San Francisco closes 1 hour before Tokyo opens, and during this period, trading continues in New Zealand. But still, the integration facilitated by technology has a dark side: the shocks that occur in one financial center now spread around the globe rapidly. The shocks here refers to events in a macroeconomic model that change the production function. They are random, unpredictable events that have a widespread impact on the economy and are caused by things outside the scope of economic models. For example, the financial crisis that started in the United States in 2008 quickly spread around the globe. But most market participants argue that the benefits of an integrated global capital market far outweigh any potential costs, and they have a relatively moderate long-term impact outside the home market. Oh, I just accidentally pressed on it. Okay. There's so many problems today. What am I gonna do? Deregulation. So next we're going to take a look at deregulation. Deregulation is another factor that's been driving the growth of global capital markets. In country after country, financial services has historically been the most tightly regulated of all industries. Governments around the world have traditionally kept other countries' financial service firms from entering their capital markets. In some cases, they have also set limits or restricted the overseas expansion of their domestic financial services firms. In many countries, the law has also segmented the domestic financial service industry. Let's take the US for example here. Until the late 1990s, commercial banks were prohibited from performing the functions of investment banks, and vice versa. Countries limits the ability of foreign investors to purchase significant equity positions in domestic companies. They also set limits on the amount of foreign investment that their citizens could undertake. Like in the 1970s, capital controls made it extremely difficult for a British investor to purchase American stocks and bonds. In the early 1980s, the restrictions came crumbling down. One reason is that it has been a response to the development of the euro currency market, which we will go to later, and from the beginning it was outside national control. Another reason is to respond to pressure from financial services companies, which have long wanted to operate in a less regulated environment. Third, increasing acceptance of the free market ideology associated with an individualistic political philosophy also plays a role in the deregulation of financial markets. There are probably a lot more reasons, but whatever it is, deregulation in a number of key countries has facilitated the growth of the international market. Financial deregulation in recent years has vastly increased the ability of the financial markets to allocate international capital efficiently. It has also sparked explosive growth in financial transactions and resulted in a restructured, more competitive, and less costly financial services industry. So this trend began in the United States in the late 1970s and early 1980s with a series of changes that allowed foreign banks to enter US capital market and domestic banks to expand their operations overseas. The so-called Big Bang in Great Britain around October 1986 removed barriers that had existed between banks and stockbrokers and allowed foreign financial service companies to enter the British stock market. Same restrictions on the entry of foreign security houses have been relaxed in Japan, and Japanese banks are now allowed to open international banking facilities. The little bang that took place in 1987 opened French stock market to outsiders and to foreign and domestic banks. In Germany, foreign banks are now allowed to lend and manage foreign euro issues. All these allowed financial services companies to transform themselves from primarily domestic companies into global operations with major offices around the whole world. Just as we saw in Chapter 8, when we were looking into international institutions and the liberalization of foreign direct investment. It's on page 251. The WTO brokered a deal in the 1997 and removed many of the restrictions on cross-border trade in financial services. The deal facilitated the growth in the size of the global capital market. Other than deregulation of the financial service industries, many countries began to dismantle capital controls in the 1970s by loosening both restrictions on inward investment by foreigners and outward investment by their own citizens and corporations. The trend spread worldwide from developed nations to the emerging economies of the world, such as Latin America, Asia, Eastern Europe, and so on in the 1980s, as they all started to tear down old restrictions on capital flows. However, the global financial crisis that happened in 2008 to 2009 put a sudden halt in the trends. Many wondered if deregulation had gotten too far and focused on setting up new regulations to govern certain sectors of the financial services industry, including hedge funds. Hedge funds are private investment funds that position themselves to make long bets on assets that they think will increase in value and short bets on assets that they think will decline in value. The hedge fund is operated by a manager who invests the money into different assets to achieve the fund's goals. A common goal for almost all hedge funds is their aim at market direction neutrality, meaning they try to make money despite the market fluctuating up or down. So if you think it this way, hedge fund managers often act more like traders. Hedge funds got their name from investors in funds holding both long and short stocks, to make sure they make money despite market fluctuations, which is called hedging, a risk management strategy employed to offset losses in investments by taking an opposite position in a related asset. Given the benefits associated with the globalization of capital, many commentators see this as a positive development, but some believe the globalization of capital holds inherent serious risks. Guys, I just realized I have so many typos in my script, which is kind of making it hard for me to read right now. Alright. I forgot to change the title here. Alright. Wow. Some analysts are concerned that due to deregulation and reduced controls on cross-border capital flows, individual nations are becoming more vulnerable to certain capital flows. They see it as a destabilizing effect on national economies. For example, Harvard economist Martin Feldstein argued that most of the capital that moves internationally is pursuing temporary gains and it shifts in and out of countries rapidly as conditions change. He distinguishes between short-term capital, aka hot money, and patient money that supports long-term cross-border capital flows. According to Feldstein, patient money is still relatively rare primarily because although capital is free to move internationally, its owners and managers still prefer to keep most of it at home. He argues that the reason behind this is that the lack of patient money is due to the relatively paucity of information that investors have about foreign investments. His view shows that investors had better information about foreign assets. The global capital market would work more efficiently and be less subject to short-term speculative capital flows. Feldstein pointed out that Mexico's economic problem in the mid-1990s was a result of too much hot money flowing into the country and flowing in and out the country, but there's too little patient money. Lack of information about the fundamental quality of investment is indeed another factor. Faced with a lack of quality information, investors may react to dramatic news events in foreign nations and pull their money out too quickly. Despite the advances in information technology, it is still rather difficult for investors to get access to the same quality and quantity of info about foreign investment opportunities that they can get about domestic investment opportunities. Given the problems created by differences in the quantity and quality of information, many international investors have yet to venture into the world of cross-border investing. And those who do are prone to reverse their decision on the basis of limited information. However, if the international capital market continues to grow, financial intermediaries will likely increase quality information about foreign investment opportunities. Investopedia also carried out the study of global market risk and summed up another three big risks international investors face: higher transaction costs, currency volatility, and liquidity risks. Currency volatility. When investing directly in a foreign market, you first have to exchange your currency into a foreign currency at the current exchange rate. Say you hold the foreign stock for a year and then sell it. That means you will have to convert the foreign currency back into your currency. And that could help or hurt your return, depending on which way your currency is moving. It is this uncertainty that scares off many investors. A financial professional would tell you that the solution to mitigating currency risk is to simply hedge your currency exposure. The available tools include currency futures, future options, and forwards. These are not strategies most individual investors would be comfortable using while undergoing investing in foreign countries. Liquidity risk. Another risk inherent in foreign markets, especially in emerging markets, is liquidity risk. This is the risk of not being able to sell an investment quickly at any time without risking substantial losses due to a political or economic crisis. There is no easy way for the average investor to protect against liquidity risk in foreign markets. Investors must pay particular attention to foreign investments that are or may become illiquid by the time they want to sell. Concerns about the volume of hot money continues to slosh around the global capital market. But research did suggest that there hasn't been an increase in the volatility of financial markets since the 1970s. I skipped. Higher transaction costs is also another reason. The biggest barrier to investing in international markets is the added transaction cost. Of course, we live in a relatively globalized and connected world right now, but transaction costs will vary greatly depending on which foreign market you are investing in. Brokerage commissions in international markets are almost always higher than United States rates. On top of the higher brokerage commissions, there can be additional charges specific to the local market. These can include stamp duties, levies, taxes, clearing fees, and exchange fees. Next, we have come to the euro currency market. A euro currency is any currency banked outside its country of origin. It is the money market for currency outside of the country where it is legal tender. Euro dollars, which account for about 2/3 of all euro currencies, are dollars banked outside the United States. Other important euro currencies include the euro yen, the euro pound, and the euro. The term euro currency is actually a misnomer, meaning the name does not really suit well because a euro currency can be created anywhere in the world, but the persistent euro prefix reflects the European origin of the market. The euro currency market has been an important and relatively low-cost source of funds for international business. The market is utilized by banks, multinational corporations, mutual funds, and hedge funds. They wish to circumvent regulatory requirements, tax laws, and interest rate caps often present in domestic banking, particularly in the United States. Let's first take a look at the genesis and growth of the euro currency market. The euro currency market was born in the mid-1950s when Eastern European holders of dollars, including the former Soviet Union, were afraid to deposit their holdings of dollars in the United States in case they will be seized by the United States government to settle U.S. residents' claims against business losses resulting from the communist takeover of Eastern Europe. These countries then deposited many of their dollar holdings in Europe, particularly in London, rather than in the United States, because they were able to earn a higher rate of interest. The market received a major push in 1957 when the British government prohibited British banks from lending British pounds to finance non-British trade. A business that had been very profitable for British banks. British banks began financing the same trade by attracting dollar deposits and lending dollars to companies engaged in international trade and investment. Because of this certain historical event, London became, and has remained until now, the leading center of euro currency trading. A fun fact for you guys. Afterwards, the market received another push in the 1960s when the United States government enacted regulations that discouraged U.S. banks from lending to non-United States residents. The dollar borrowers outside the United States found it increasingly difficult to borrow dollars in the United States to finance international trade. So they turned to the euro-dollar markets again to obtain the necessary dollar funds. The United States government changed its policies after the 1973 collapse of the Bretton Woods system by removing an important impetus to the growth of the euro currency market. However, the oil price incident that happened around 1973, on and off till 1980, gave the market another big shove. As a result of the oil prices increasing, the Arab members of OPEC accumulated huge amounts of dollars. They were afraid to place their money in United States banks or their European branches, just in case the United States government attempts to confiscate them. So again, these countries deposited their dollars with banks in London, further increasing the supply of euro dollars. These political events did contribute to the growth of the euro currency market, but they are not major players. The market grew because it offered real financial advantages, initially to those who wanted to deposit dollars or borrow dollars, and later to those who wanted to deposit and borrow other currencies. So next we're going to look at the benefits and attractions of the euro currency market. The main factor that makes the euro currency market attractive to both depositors and borrowers is its lack of government regulation. Banks are allowed to offer higher interest rates on euro currency deposits than on deposits made in the home currency, making euro currency deposits attractive to those who have cash deposits. The lack of regulation also allows banks to charge borrowers a lower interest rate for euro currency borrowings than for borrowings in the home currency, making euro currency loans much more attractive for those who want to borrow money. Domestic currency deposits are regulated in all industrialized countries. These regulations ensure that banks have enough liquid funds to satisfy demand if large numbers of domestic depositors should suddenly decide to withdraw their money. For example, each time a United States bank accepts a deposit in dollars, it must place some fraction of that deposit in a non-interest-bearing account at a Federal Reserve Bank as part of its required reserves. So similar happens to banks in Great Britain. However, banks are given much more freedom in their dealings in foreign currencies in the euro currency market. For example, the British government does not impose reserve requirement restrictions on deposits of foreign currencies within its borders. This gives Eurobanks a competitive advantage. Eurobanks offer higher interest rates on dollar deposits compared to banks in the United States. There are strong financial motivations for companies to use the euro currency market because they receive a higher interest rate on deposits and pay less for loans. But surprisingly, the euro market has grown so rapidly, but it hasn't grown even faster. Why is that? Why do any depositors hold deposits in their home country, in their home currency, that they can get when they could get better yields in the euro currency market and be better off? So why is it, you guys? The drawbacks and risks. So the euro currency has two major drawbacks. The first reason is when depositors use a regulated banking system, they know that the probability of a bank failure that would cause them to lose their deposits is very low because regulation maintains the liquidity of the banking system. In an unregulated system such as the euro currency market, the probability of a bank failure that would cause depositors to lose their money is a bit greater. So some depositors are more comfortable with the security of such a system and are willing to pay the price. The second reason is borrowing funds internationally can expose a company to foreign exchange risk. Let's take a look at the example given in the book. Consider a US company that uses the euro currency market to borrow euro pounds because of lower interest rates. Now imagine, however, that the British pound subsequently appreciates against the dollar. This would increase the dollar cost of repaying the euro pound loan and further lead to the company's cost of capital. This shows that the foreign exchange market does not offer perfect insurance, which later resulted in why many companies choose to borrow funds in their domestic currency to avoid foreign exchange risk, even though the euro currency markets may offer more attractive interest rates. Next, we'll take a look at the global bond market. A bond is a fixed income instrument that represents a loan made by an investor to a borrower. A global bond, sometimes referred to as a Eurobond, is a type of bond issued and traded outside the country where the currency of the bond is denominated. The global bond market has grown rapidly over the last 4 decades and are rather important means of financing for many companies. The most common kind of bond is the fixed-rate bond, in which the investor who purchases a fixed-rate bond receives a fixed set of cash payoffs. Each year until the bond matures, the investor gets an interest payment, and then at maturity he gets back the face value of the bond. There are 2 types of international bonds: foreign bonds and Eurobonds. Foreign bonds are sold outside the borrower's country and are denominated in the currency of the country in which they are issued, such as when Dow Chemical, an American multinational chemical corporation headquartered in Midland, Michigan, issues bonds in Japanese yen and sells them in Japan. It is issuing foreign bonds. Many foreign bonds have nicknames, such as foreign bonds sold in the United States are called Yankee bonds. Foreign bonds sold in Japan are called samurai bonds. And foreign bonds sold in Great Britain are called the bulldogs, which I kind of think is really cute. So far, foreign firms doing a large amount of business in the domestic market issuing foreign bonds is a common practice. Eurobonds are normally underwritten by an international syndicate of banks and placed in countries other than the one in whose currency the bond is denominated. For example, a bond may be issued by a German corporation denominated in US dollars and sold to investors outside the United States by an international syndicate of banks. Multinational corporations, large domestic corporations, sovereign governments, and international institutions usually issue Eurobonds. The popularity of Eurobonds as a financing tool reflects their high degree of flexibility as they offer issuers the ability to choose the country of issuance based on the regulatory landscape, interest rates, and depth of the market. They are also attractive to investors because they usually have small par values or face values, providing a low-cost investment. Eurobonds also have high liquidity, meaning they can be bought and sold easily. Other features of the Eurobond market is that it makes it a more appealing and attractive alternative to most major domestic bond markets, including its absence of regulatory interference, less stringent disclosure requirements than in most domestic bond markets, and a favorable tax status. Regulatory interference. National governments often impose controls on domestic and foreign issuers of bonds denominated in the local currency and sold within their national boundaries. However, Government limitations are generally less stringent for securities denominated in foreign currencies and sold to foreign holders of these foreign currencies. Wait, let me reread this. National governments often impose controls on domestic and foreign issuers of bonds denominated in the local currency and those who sell within their national boundaries. However, government limitations are less stringent for securities denominated in foreign currencies and sold to holders of those foreign currencies. Eurobonds falls outside the regulatory domain of any single nation, so they can often be issued at a lower cost to the issuer. Eurobond market disclosure requirements tend to be less strict than those of several national governments. For example, if a firm wishes to issue dollar-denominated bonds within the United States, it must first comply with SEC disclosure requirements. The firm must disclose detailed information about its activities, the salaries and other compensation of its senior executives, stock traders by its senior executives, etc. They also have to submit financial accounts that conform to U.S. accounting standards. But if you think, for non-domestic firms, redoing their accounts to make them consistent with the U.S. standards can be very time-consuming and very expensive at the same time. It is so much easier and cheaper to issue Eurobonds, including those denominated in dollars, than to issue dollar-denominated bonds within the United States. One of the most important things about Eurobonds is that they are unlike many other types of bonds, not taxed at source. In other words, when investors in a bond receive interest payments, they aren't taxed on that income, meaning they don't have to pay taxes. Eurobonds are major vehicles for tax avoidance and evasion. Before 1984, U.S. corporations issuing Eurobonds were required to withhold for U.S. income tax up to 30% of each interest payment to foreigners. This did not encourage foreigners to hold bonds issued by U.S. corporations. The laws were then revised in 1984 to exempt from any withholding tax foreign holders of bonds issued by United States corporations. U.S. corporations found it feasible for the first time to sell Eurobonds directly to foreigners after the revision. Following the United States, France, Germany, and Japan also liberalized their tax laws likewise to avoid outflows of capital from their own markets. The global equity market. The equity market is a place where stocks and shares of companies are traded. The equities that are traded in an equity market are either over the counter or at stock exchanges. Often called a stock market or share market, an equity market allows sellers and buyers to deal in equity or shares in the same platform. Historically, regulatory barriers separated national equity markets from each other. Not only was it difficult to take capital out of a country and invest it somewhere else, but corporations also frequently lacked the ability to list their shares on stock markets outside their home nations. These regulatory barriers made it difficult for a corporation to attract significant equity capital from foreign investors. But the barriers were taken down during the 1980s and 1990s. The global equity market allows firms to attract capital from international investors, to list their stock on multiple exchanges, and to raise funds by issuing equity or debt around the world. Many companies are now listing their stock in the equity markets of other nations, primarily as a prelude to issuing stocks in those markets to raise additional capital. Other reasons for listing stock in another country's exchange is to facilitate future stock swaps, to enable the company to use its stocks and stock options for compensating local management and employees, to satisfy local ownership desires and to increase the company's visibility among its local employees, customers, suppliers, and bankers. For example, in 1994, Daimler-Benz, Germany's largest industrial company, raised $300 million by issuing new shares not in Germany, but in Singapore. Similarly, in 1996, the German telecommunications provider Deutsche Telekom raised Deutsche Telekom raised some $13.3 billion by simultaneously listing its shares for sale on stock exchanges in Frankfurt, London, New York, and Tokyo. The German company's reason to do so was because their domestic capital market was too small to supply the requisite funds at a reasonable cost. So in order to lower their cost of capital, they tapped into the large and highly liquid global capital market. More recently, Chinese firms and companies have also been raising equity capital through foreign stock issues. In 2014, in what was the largest IPO ever, the Chinese internet company Alibaba raised $25 billion in equity capital on the New York Stock Exchange. We have talked about the growth of the global equity market, but strictly speaking, there is no international equity market in the sense that there are international currency and bond markets. Rather, countries have their own domestic equity markets in which corporate stock is traded, and the largest of these domestic equity markets are to be found in Japan, Hong Kong, Great Britain, and the United States. A second development internationalizing the world equity market is that companies with historic roots in one nation are expanding their stock ownership by listing their stock in the equity market of other nations for financial reasons. Listing stocks on a foreign market leads to issuing stock in that foreign market, which then raises capital. Firms also often list their stock on foreign equity markets to facilitate future acquisitions of foreign companies. Foreign exchange risk and the cost of capital. Foreign exchange risk refers to the losses that an international financial transaction may incur due to currency fluctuations, guys. Foreign exchange risk can also affect investors who trade in international markets and businesses engaged in the import-export of products or services to multiple countries. Although firms may borrow funds at a lower cost in the global capital market than in the domestic capital market, foreign exchange risk complicates the process. Adverse movements in foreign exchange rates can increase the cost of foreign currency loans, which is what happened to many Asian companies during the 1997 to 1994 Asian financial crisis. Our textbook actually gave us a very vivid example on how foreign exchange might make the tables turn. Let's take a look at the South Korean firm that wants to borrow 1 billion Korean won for 1 year to fund a capital investment project. The company can borrow this money from a Korean bank at an interest rate of 10%, but at the end of the year, it needs to pay back the loan plus interest for a total of 1.10 billion won. Well, the company has another option. Instead of borrowing from a Korean bank, the firm could borrow dollars from an international bank at a 6% interest rate, which is lower than the 10%, meaning and at the prevailing exchange rate of $1 equals 1,000 won, the firm would borrow $1 million and the total loan cost would be 1.06 billion won. Doing so allows the firms to reduce the cost of capital by 4%, or 40 million won. However, this is only possible that during the year of the loan, the dollar and won exchange rate stays constant. Instead, let's imagine that the won depreciates sharply against the US dollar during the year and ends the year at $1 equals 1,500 won. The firm still has to pay the international bank 1.06 million at the end of the year. But now, this costs the company 1.59 billion won if you times 1.06 million USD and 15,000. The depreciation resulted in the rise from 6% to 59%, a huge rise in the firm's cost of capital. To understand this more clearly, unpredictable movements in exchange rates can inject risk into foreign currency borrowing, making something that initially seems less expensive ultimately much more expensive. When a firm borrows funds from the global capital market, it must weigh the benefits of a lower interest rate against the risk of an increase in the real cost of capital due to adverse exchange rate movements. Although using forward exchange markets may lower foreign exchange risk with short-term borrowings, it cannot totally remove the risk. The forward exchange market does not provide adequate coverage for long-term borrowings. Focus on managerial implications. We have come to the last part at last. So, Chapter 12's implications are pretty straightforward, and the materials discussed in this chapter for international business is really important. It is fundamental to have a full understanding in this subject before putting yourself out into the turns and turmoils of the global capital market. The growth of the global capital market has created so many opportunities for international businesses that wish to borrow and/or invest money. Let's look at the borrowing side. By using the global capital market, firms can often borrow funds at a lower cost than it is possible in a domestic capital market, no matter what form of borrowing a firm uses. It can be equity, bonds, or cash loans. The lower cost of capital on the global market reflects its greater liquidity and the general absence of government regulation. Domestic capital markets couldn't escape the hands of government regulations, but the global market, being transnational, has no fear of government regulations. Although you must understand the foreign exchange risk associated with borrowing in a foreign currency. Now look at the investment side. The growth of the global capital market is providing opportunities for firms, institutions, and individuals to diversify their investments to limit risk. Like said earlier, holding a diverse portfolio of stocks and bonds in different nations can reduce an investor's total risk to a lower level. However, foreign exchange risk is a complicating factor. As complicated as I was reading this chapter. And this is where I'm going to sum up today's chapter. Thank you for listening, and hopefully you've all learned something new today. This chapter is short, but it's quite challenging. So I hope you guys are still alive listening to this. Thank you.